The broadcast is now starting. All attendees are in listen-only mode.
Welcome, everybody, to the February session of Turnout Tuesday. It's been postponed for a couple of weeks. My friend Mark is feeling much better now, and he has his voice back. So we're coming to you 2 weeks late, but we are coming to you. This is Ken Cavula from the Mid-Michigan chapter, and we'll try to run this program, 8 or 10 times a year, and we'll keep you informed as to dates, times, and program. We won't start this program until 8:30, so we do have 5 minutes right now for you to take a look at your sound equipment. You do have the ability to raise your hand if you want to make a comment. If you don't feel like speaking, you can use the chat box and you can ask us a question. I guess it's called the questions box, and you can ask us a question and we'll try to respond to it. You can also make a comment in that questions box. Doesn't have to be a question. And we'll get started right at 8:30. It's just Mark and I tonight, and we're going to try to go for an hour and 5 minutes, something along that line. That's our goal.
Depends on how long you still have a voice.
Your voice. So I have a question here from Martha. She says, are you doing an educational event in St. Louis in March? Is it open to all? How do you register? And the answer, Martha, is yes, we are doing an event in March. It's going to be on the 24th of March. And I would imagine if you go to the St. Louis chapter website on the Better Investing page, you'll be able to find the details as far as location and registration. I don't even know if we have the location yet, do we, Mark?
We do, and in fact, within the next day or so, I'll be posting some event information that was provided by the St. Louis team.
Well, there you are, Martha. It'll be right on the Manifest site as well. And if you're having a trouble finding it, drop Mark an email, and I'm sure he'll send you a copy of whatever he's going to post real quickly. That'll be a pretty good size, not so good size event, but it'll be a longish event, maybe 4 or 5 hours. And again, the date is March 24th. More details to follow. Mark and I are also going to be in Cincinnati in, I think it's April. Isn't that correct, Mark?
Well, don't ask me the date.
It is correct. It is. It's April 21st. We're going to be in Cincinnati on the 21st of April. So if you're in the Cincinnati area, we're actually going to be a little bit north of Cincinnati, between Cincinnati and Dayton. So if you're in that area, feel free to look that up on the OKI website. That's the name of the chapter that covers the Cincinnati area. O, Ohio, K, Kentucky, I, Indiana. The OKI chapter will be putting that.
Well, greetings, everybody, and welcome to tonight's Turnout Tuesday session here on February 20th. I apologize for us being a couple weeks postponed from back in the days when I was fighting the bubonic plague, and I actually lost my voice completely a couple weeks ago, and it's been a couple interesting weeks. We'll spend some time talking about that. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by my dear friend Ken Cavula, who is the grand poobah of national investing education, works an awful lot with the Better Investing teams all around the country, and we both thoroughly enjoy doing that. Tonight's program is just simply throwing together some questions and issues and topics that you want to talk about, and we'll simply share some thoughts on a couple of things. We'll leave a little time for Q&A if we can. And you may have thought that Groundhog Day is over. Here at Manifest Investing, Groundhog Day is actually Groundhog Month. So that's Punxsutawney Phil. They're being lifted up into the glow of 6 more weeks of winter. But February 2nd, Groundhog Day, is our national holiday. Actually, I would say it's a global holiday. It's the day that we founded Manifest Investing, and we have a lot of fun with Groundhog. We'll talk about that a little bit more here in a minute. Let's get some of the legal paperwork out of the way. We're going to talk about companies and methods and that type of stuff. No investment recommendation is intended. This is all about demonstration and education. We do a lot with demonstration and illustration of the philosophies and principles of the modern investment club movement. And please do your own homework. If you'd like to be added to a reminder list about this webcast or the roundtables, you can drop a note to Natalie Cavula, ncavula1@comcast.net. And I've been getting a bunch of those lately, so I'm sure Natalie's been adding people to the roster. Here's our agenda for tonight. Ken and I are going to talk about these things. I do want to spend just a few minutes. People have been asking about the groundhog results. They're really pretty cool and just a whole lot of fun. And we want to talk about bearable markets. I think that's the main topic for tonight, really. 2 weeks ago, we were just beginning a fairly nasty correction. We had a bull market on a rampage, and we were starting to take a bit of a time out. And wow, the last couple of weeks have made a pretty significant difference. And we want to talk about that whole challenge in the context of perspective and, why we do what we do and why it works. So we want to talk about this growth experience and what we do and what actually seems to happen as the years and decades go by. And we'll spend just a few minutes talking about, I've actually labeled it tectonic tax turbulence because it is a fairly tectonic moment. Some of the changes that are happening in the tax code and with the repatriation stuff is causing a fairly massive disruption in our analytical tools, and we want to at least be aware of that as we begin to learn how to account for that and continue to build our expectations for companies going forward. And as I said, we'll try to leave some time for questions and answers. Any questions or comments at this point, Ken?
No, we're pretty well caught up, Mark. So why don't you press on forward, okay?
Okay, we will press on. Hey, the groundhog contest. This is really pretty neat stuff. We've been doing this now 11 years. We're in our 12th annual challenge, which started again just on Groundhog Day a couple of weeks ago. But these are the results over the years. For the year 2017, Groundhog Day just ended. We actually came in with this 30.6 result you see on the right. And with the stock market checking in as measured by the Wilshire 5000, that came in at 22.4. So we beat the market by about 8 percentage points. So we've actually beat the market about half of the years that are shown in this chart, including the first 3 rather spectacular years, and then a couple other pretty good years. This was the second best year in the contest. And I would say that people take a pretty long-term perspective when it comes to the contest itself, and it's not just a swing for the fences thing. And you'll see that as we look at a little bit closer at some of the long-term results. But the really important number is since the inception of the contest over 11 years ago, the annualized total return for all of the participants in it is 10.7% versus 8.3% for the Wilshire 5000. So again, this contest, again, we recognize it is just a game, but people are pretty serious about the selections that they make. In many cases, they are nominating or selecting stocks that are in their actual club or individual portfolios. So it's really kind of a neat thing to watch over time. Our winners this year are Hugh McManus, drum roll, or whatever you do for the Irishman dominating the contest here over the last few years. He's now won twice in the last 4 years. And he does it fairly unconventionally. Well, actually in the true spirit of George Nicholson. He's got a handful of very core stocks like Kellogg or Aflac, and then he will pick a couple fairly speculative biotechs, and that's been his formula for success. And the group champions are also repeat champions. They're our northern traders from Traverse City, Michigan. They last won in 2011, so they are also repeat champions. I believe Mr. Lemcool is with us here tonight. Congratulations, Herb. Herb and Barb are both charter members of that club, along with Bivio's Lori Madison and Chuck Brunell and a couple others. Trying to think who else is in that club. But again, a big shout out of congratulations to Herb Lemcool. And again, just that reminder that everybody involved is actually doing pretty well, and we'll demonstrate how this can be a source of ideas for somebody interested in investing. Here were the final results for last year. 2/3 of the people participating beat the market. And you can see that Hugh McManus checked in and managed to achieve an 82 point, actually almost 83% return for the year. We know that because everybody starts with $1 million Groundhog dollars on Groundhog Day 2017. We check in and measure it a year later. That relative return is how much it beats the market by. So you can see there's some pretty familiar names on that list. You see the Northern Traders. You'll see the Broad Assets. The Broad Assets are back every year. Paul Witt from Midland, Michigan on the list. I actually managed to make the list a little bit there. Kurt Kowit in the number 6 spot, our technology guy. And again, we wrote an article a few years ago that he spends, what do you suppose, Ken, 5 minutes doing his picks every year?
At the most, Mark.
I mean, he literally runs a quick screen using our stuff and tosses 5 stocks, and we'll basically pick them and go away for the rest of the year. But I would like you to notice that there's a lot more individuals participating compared to the number of, or the population of investment clubs, and anything with a parentheses there is an investment club. Notice the number of them that have basically, like cream rising to the top. We really do believe that more heads are better than one in many cases, and it's just kind of fascinating to watch some of these clubs year in and year out challenge for that leaderboard position. Any comments or questions, Ken?
No, except that I'm going to take my model club's portfolio and use it for my own next year. I see Baker makes the top list here, but I missed it, so I'm gonna have to work harder to beat them next year.
You didn't do too badly, as we're going to see here in the all-time results here in a second. Here you go. This is probably one of my favorite slides. What you're looking at here is the all-time. Think of it as a Groundhog Hall of Fame. In order to make this list, you have to participate for at least 3 years. And what we're looking at here is the annualized returns, specifically this middle column that says average return. That's the annualized return for whatever period that you have participated. And the number of years of participation are on the far right. So in the case of the Broad Assets Investment Club, this group of mostly ladies, I think they have one guy, you can see they came in at 49.4% last year, which again beats the market by 27%, but their average result for the 6 years that they've participated is 36.7. And that actually beats the market by 21.7%. I'm having a hard time with that number. You're the mathematician, Ken. That's pretty significant that they've been able to do that for 6 years, huh?
I think so. I don't think we can do mathematicians on it. We can't do any probabilities on it, but it just strikes you as being something that's very difficult to do. And I think a lot of the professionals in the audience, or a lot of professionals in the investing world, would tell us that it can't be done, that people can't do it.
Yeah,
and yet here's the numbers.
We've tried to take and extrapolate some lessons from the broad assets, and one of the things we think we noticed was they watched for companies that seemed to be poised for huge upticks in earnings from the current year to the next year. And we actually have built some screens that attempt to identify some of those companies, trying to capture that type. We call it a launch pad mentality, just like a liftoff. But again, pretty fascinating to watch. So again, you see the number of years. We have some newcomers, the Long-Term Investment Club out of Wichita, Kansas. John Kimmel's the ringleader of that bunch. You can see they're actually challenging for the top. Those ones at the top, if they can maintain that for a few more years, we're talking super investor status. When I refer to a super investor, I mean Graham and Doddsville type moments. Walter Schloss didn't do this well, and neither has Warren Buffett. So kind of interesting to watch. So you see Paul Witt, one of our annual winners, Hugh McManus, the 2-time winner, the Sirius Investment Club out of Pittsburgh, a nod to Nick Strategos and his investing team there. Andy Pagork out of Chicago. I actually am still on this list. I've been near the top of this over the years, and I'm fighting to stay there. Kim Butcher, one of our guest damsels. Susan Michalek's investment club is the 4th investment club listed here. So as you look down that list from top to bottom, you see some fairly common names. Herb Lemcool on here. Again, if they're a participant in the roundtable program, it's a pretty good chance they're going to show up on this list. You see both Rod and Anna Gombar, including Anna's husband there. And again, just from top to bottom, some fairly interesting numbers. Again, these are all participants who have beaten the market over at least 3 years, but some in many cases more than that. Good, clean fun. I mentioned before, we think that some pretty good ideas for further study tend to come out of the contest. These were the most commonly selected stocks a year ago. We refer to them as the heavy hogs. And these were the 10 most favorited, most commonly or frequently selected stocks a year ago. And you can just look at the stock from top to bottom. They average out to a gain of 42%. And Ken, I think you have a few of those, huh? Go ahead, Brad.
Yeah, before we started, I looked at this list right here, and I'm happy to say from my real portfolio that I own 8 of these 10 stocks right here. I used to own 9, but I did sell NIC eGov. I did sell it, oh golly gee, about 2 years ago now. But I've never owned Mercado Libre. I have a certain bias against companies that are based in places where the currency goes from 0 to infinity and beyond. So I just have a real problem with an Argentinian company when I know that the currency in Argentina can be worth almost anything at almost any given day. So, but the stock Mercado Libre has certainly done well in U.S. dollars. And one of my favorites here, one of the largest holdings in 2 of the clubs that I'm in, is Proto Labs. In fact, we're dealing with the issue right now about what to do with Proto Labs. It's taken over about 20% of my primary investment club portfolio, and we have been cutting it back on a fairly regular basis. Even in our brand new model club, B.I. Baker, we've had to cut Proto Labs back once already because it had jumped up to such a great portion of the portfolio. So you could do worse to look at the heavy hogs for 2018 and put a group together. Mark, it reminds me of the Your Choice portfolio from our own contest here in mid-Michigan.
I was going to ask about
We've
that.
we've been running that contest for 15 or 16 years now, and that portfolio, which is the most commonly picked stocks in the clubs that are in the contest, that portfolio has beat the market all but 2 years out of the 15. So these contests really do give us a pretty decent list of ideas to take a serious look at.
I imagine your problem with the Brazilian currency gets in the way of probably Argentinian, yeah. So you're probably not all that comfortable with Bitcoin then either, huh?
No, I'm not, Mark.
All right.
I listened to your nephew try to convince me that it was something I should put real money into, and he didn't convince me. So
I need an update from him. All right, here's your 10 stocks for this year. These were the consensus favorites. Many repeats on the list, but Cognizant, Five Below, Skyworks, Starbucks, Priceline, Alliance Data, Celgene, CVS makes another appearance. I think CVS over the long term has probably got some pretty decent days ahead of it. Facebook and Ulta Beauty, a fairly recent selection. Ken, I think you featured Ulta on a recent roundtable, and
I've picked it 2 or 3 times on the roundtable, and some other folks have picked it as well at the roundtable.
Right. So many of these on here are roundtable stocks, and the others are followed by Eddie at crossingwallstreet.com. But I think there's some fairly decent studies in here. Ulta and CVS, even Celgene. I think all 3 of us said Celgene was on our short list. None of us picked it last month, but it's a company that might be worth a real thorough head scratching and digging in a little bit deeper to see what can be expected from that company. But one of the other things I wanted to mention from just this small group, I mean, 10 stocks is a relatively small set, but you're looking at 10 stocks that have a decent return forecast of 15.6. So in terms of thinking about it as a portfolio, with the market as toppy as it is right now, it's probably very prudent to have exceptionally high quality. So we're looking at that from our Groundhog Nation. And then probably even more importantly, over here, the average sales growth is about 13%. So those three portfolio characteristics from a design and management standpoint are all pretty strong and probably bode pretty well. I mean, anything can happen in the course of a year, but over the long term, and we'll be talking about that here shortly, becomes a very important component. So again, we just want to leave you. Go ahead, Ken.
Well, what I like on this list, Mark, is the quality column. I mean, we're looking at when this contest began, and I've been in the contest since the beginning 11 years ago. When this contest began, a lot of us, you and me included, tried to swing for the fence. And tried to be as interesting and novel as we could in our choices. And sometimes we had huge gains. There was a year when Paul Witt from one of our model clubs chose only one stock. He generated the Witt rule in future years where you couldn't do that anymore. But he chose only one stock, and it was kind of obscure, but he won the contest because it just took off and did all kinds of wild things. But in the last 6 or 7 years, I know that I've moved to portfolios now that are basically high quality stocks. Perhaps if I make 10 or 11 stock picks, I'll put one stock in there that I think might be a high flyer. But for the most part, I'm choosing high quality, and my results in the last 6 or 7 years have been much better than they were in the first 5 or 6 years of the contest.
Yeah, absolutely. So we'll be publishing the complete set of results, and then also sharing some of the thoughts of Hugh McManus on places where you might go shopping for some of those launchpad or early stage stocks. One of them he's talking about is Crunchbase or something. I'll share it with you as soon as I figure out exactly what he's looking at. It's kind of tough to tie him down. He's traveling around so much. Also wanted to point out to those of you that want to check in on this during the year, you can actually punch in that public URL or website, heavy-hogs-2018, and you can actually track the progress of the $1 million we've got invested here, $100,000 invested into each one of these. You can track it as the year goes by. So again, just our quick reminder that we think this stuff does have a time-honored basis. The teachings of people like Benjamin Graham, who taught Warren Buffett how to invest, David L. Babson, we'll talk about here in a few minutes, and George Nicholson. And we think that following those disciplines of identifying core growth stocks with decent return forecasts and sufficient quality, and every once in a while getting playful can be a path to exceptional returns. I know that many of you in the audience have experienced those types of returns over the last year, and it just brings a smile to a whole bunch of faces around here. All right, Ken, let's go ahead and switch and talk about this notion of bearable markets. I just observed, wow, I mean, I lose my voice and the stock market falls apart. The last 2 weeks have been interesting. Are you starting to see any correspondence from people wondering if it's time to for the sky to fall or time to run for the hills?
Well, I know that the market's having some issues. I don't even have to turn on my television to know that the market's having issues because my phone starts to ring.
Yep.
And it's the clubs that we've built relationships with in mid-Michigan here, and they're calling, and a lot of times they're just calling for a pep talk. They just want to be reassured that there's nothing that's really changed, nothing that's really altered in our high quality companies that we focus on to warrant them moving up as quickly as they did, or to warrant them moving down as quickly as they did. Obviously, it's a lot more fun to watch them move up really fast, but anybody that's been doing this for any amount of time knows that we were moving up pretty quickly for the last, since maybe the election, since October, November of last year, and we were due for a pause, if nothing else. I didn't anticipate the up and down movement of that pause. I kind of thought the market would just kind of mark time for a period, but it certainly took it upon itself to back itself way up a little bit. And I'm comfortable with where the market is right now. I think it's fairly valued, or maybe even a little bit undervalued, because I'm not sure that anybody has really figured out the impact of this tax cut. I know we're going to try to do some talking about it tonight, but I think it's going to have a huge impact, and unfortunately, our tools are kind of at a disadvantage. Our whole idea of a business model is kind of at a disadvantage right now until we get a little bit more data where we can begin to understand what the new tax rates will be and whether or not our company that we're studying is going to turn some of that tax windfall, if you will, turn that into money that they spend on their employees or on new equipment or on building something, because if they do, that'll impact their margins. And I need to understand that all these things are kind of in a little bit of a state of flux, and I'm not going to be able to depend on the historical numbers nearly as much as I would have 6 months ago when I was using preferred procedure and trying to form a business model with the whole thing. I love Bob Adams' question here, where he basically says, does it really happen that markets go up more slowly than they go down? Do my stocks really not make as much money on the upward side as they lose on the downward side? And Mark has done some thinking about that. Why don't you tell the folks what you've kind of worked your way through here, Mark?
Yeah, and I just want to, again, just reinforce just a little bit about this notion of bearable markets. I spent a lot of time in the professional investing world watching people, I'm going to just say obsess, I'm sugarcoating, with protecting themselves against the market. And, you know, I had dinner with, we're going to talk about the Dankos here in a minute, with Don and Nancy Danko again. I was just powerfully reminded of one of the reasons that the stuff that we do is so important and works so well is we really are not that driven by markets. And we spend our time discovering excellent companies that are on sale. We buy them and we hold them for as long as it makes sense to do so. And that really is kind of a magic formula. So we'll come back to that here in a second. I just wanted to point out how interesting the last 2 weeks has been since I lost my voice. We were supposed to get together towards the beginning of February, back towards the beginning of February. We were hitting all-time highs as measured here by the value line arithmetic average. So stock prices were hitting all-time highs and the return forecasts were hitting all-time lows. And we said, you know, you can go back and you can listen to the things that we say. You can go back for now 15 years and the things we say. We don't know when the next correction or bear market's going to hit. But what we do know when we see this picture is that our stocks are more vulnerable to a correction, and they certainly proved that in a fairly spectacular way. They're just more vulnerable. Nobody knows when or how big the correction will happen, but we just know that they are more vulnerable. And if you go back to the things that we've been talking about for the last 6 to 9 months, it's simply make sure you don't lose the emphasis and the focus on quality. Because just a couple of weeks later, the stock market did correct. You can see that the green bar actually took a bit of a dive up here at the top and came down a few percentage points. 10% makes it a bear market correction. And simply that drop in stock prices actually has restored that return forecast back to levels where it had been. And again, it can maintain at those levels. Look at this period right here, where even though the return forecasts were actually fairly low, you're talking about a period of a couple of years where stock prices continued to ascend. So again, we don't know when these things are going to happen. All we can say is we know when our stocks are more vulnerable to a correction. That was certainly true 2 weeks ago, less true today. So again, going back to the Dankos and the thoughts that we shared that evening, he actually wrote a piece back in October 1991 in Better Investing. He was the editor of Better Investing at the time, and he pointed out that, again, just like it says here, stocks, not markets, are what really make us successful. And if you want to read the full text of that editorial, you can actually go to expectingalpha.com, just like it says up here at the top. And this is the featured article right now at the top. And what I thought we might do is spend just a few minutes with this closing paragraph, because I hear Don Danko, but at the same time I can almost hear Ken Kavula echoing with these words. So let's spend a few minutes just thinking about how important this stuff is and how it works. So, Ken, this sure sounds an awful lot like you.
Well, I just pulled out some old presentations that I was reworking and stealing some of my own slides to put in some newer presentations and to rework them. And I'm amazed, Mark, at the number of times the word discipline comes up on a slide. Sometimes it's the only word on a slide as I'm talking through some points. And right along with discipline comes the word patience. When I'm talking about investing, especially when I'm doing cheerleading kind of stuff and pep rallies for clubs in our area that are a little bit frightened by these huge swings in the market, I'm talking about the fact that we're in this for the long term. We're not in this for 3 weeks or 4 weeks or 2 weeks. We're in this for 20 or 30 or 40 years, and you have to be patient, and most importantly, you have to be disciplined. You have to know what your rules are and what your tolerances are, and then you have to stick with them. Mark, that question from Bob Adams kind of dovetails with this, because he talks about underperforming the market when the market's doing really well, but doing much better in challenging markets than you would expect, because his stocks just tend to have a relative return that come out and shine when you're looking at a very challenging market. I think we've seen that in the roundtable portfolio itself, where we've been able to make big moves upward on our relative return during very challenging times. Take the Great Recession, for example. But then during times when the market's been moving along at 30-35%, we've been kind of happy just to kind of go along for the ride and to match that performance with our high quality stocks. I think that when you buy a stock, you have to set yourself a thesis for why you own it. You have to ask yourself, what's the reason that this stock is as good as it is? What makes it high quality? And most importantly, what's the facts? What's the basis for the growth to continue? Is something going to happen to allow this company to continue to grow? And as long as those most basic tenets are not violated in your company, then you need the discipline to keep that stock in your portfolio. And at times when it seems to be selling at a ridiculously low price, you even need the discipline sometimes to buy more of it, even though the market might be telling you on a short-term basis that it's not an extremely good investment. This discipline about sticking to your guns, following your stock selection guides, watching the kinds of things that Mark and I have talked about over the years, and especially focusing on quality. Don was talking about this back in the late 90s, and we've been talking about it ever since we started joining together as a team and going around the country and appearing all over the place, trying to let people know that even though the experts tell us that as individual non-professional investors, we can't do what we do. We can demonstrate that we're able to do it on a regular basis, and not just you and me, but thousands and thousands of people throughout the country and hundreds of investment clubs.
Well, I know you've been an outspoken critic of the 24/7 news cycle, so I think the last paragraph here contains a very powerful reminder for all of us. So, and I'll just read it. There's little in today's news that has a bearing on the wealth that an individual can accumulate over his or her lifetime. Money can be made in all types of markets. The focus has to be on the long term. It's stocks, not markets, that bring investment success. And I think that drives a lot of the financial professionals crazy. They think you have to work harder at it than we really do. But again, the stuff that rattles across all the various news outlets every time that the news anchor starts the nightly news with your 401k took a bashing today. I think that the ticker running across the bottom of the screen should include that comment. There's very little in today's news that has any bearing on the wealth that you can accumulate. Just a pet peeve of mine, and it's just a powerful reminder that keep
You,
your eye on the long-term ball.
Mark, you and I drive so much throughout the country, and we have so many hours in the car to solve so many problems. And there's occasionally times when you just shut me right up with something you say, and then I have to sit and think about it for 15 or 20 minutes, and it goes vice versa. And I still remember saying to you in one of our early trips that if you want to buy a small stock, it's a really good idea. And you just have to demand out of your small stuff the same stuff that you demand out of your big stuff. You have to keep that discipline. You have to keep that patience. And a small company shouldn't be that different than a big company, except maybe the numbers and maybe the rate of growth. And you started to tell me that that wasn't true, and then you stopped.
I deny it.
And you got very quiet. And now we both say the same thing, that there are all kinds of stocks out there, and our people that put this whole philosophy together were really, really smart people, and we don't have to go and reinvent everything. We just have to stay true to some of the basic tenets that they told us about 50, 60, 70 years ago.
Yeah, one of the more powerful buzzwords right now is evidence-based. In a couple of different areas, but evidence-based investing, and we certainly have a pile of evidence about the potential for smaller company stocks. Let's go ahead and press on a little bit. Again, this kind of comes back to Bob Adams and his question. Just made me think about something that I've never really taken a look at. Do our stocks go up more during bull markets and down more during bear markets, but down a little bit less, and basically balances out to a very nice return over the long term because of the way things seem to behave? Well, that question kind of is very closely related to the concept of beta. Now, we don't really talk about beta, don't really even believe in it that much, but here's the definition from Investopedia.com. A stock with a beta of 1 means that the stock price would move with the market. If that number is higher, like 1.2, like it says right here, it means that stock's going to move 20% faster than the market going up, or 25% faster to the downside going in the other direction. And then if a stock has a beta less than 1, it's less volatile. It's going to move less than the market up and move less than the market going down. That's typically going to be found in the more defensive stuff. So I took our most widely followed companies, the Manifest 40, and just threw the beta at them here from Apple all the way down to Priceline.com. And we do notice that we do have a beta slightly higher than 1. So that would actually align pretty well with Bob Adams' question as to, do our stocks tend to outpace the bull and perhaps even go down a little bit more than the bear, but over the long term, the trade-off is one that's been quite favorable for him. So that, again, we're talking about his sample is small, our sample is small, but it's kind of fascinating. I'd never put together a chart like this using beta for the stocks that are most frequently talked about in our community. My personal opinion is the reason that this stuff works for us is that we do buy companies when they're on sale. We try to buy them when they're in the buy zone or when their returns forecast is sufficient. So that's when these companies were added to the list under those conditions, and they stay there because they continue to qualify. But even more importantly, we know that the higher quality stocks tend to get beat up less during a correction or bear market. And that's certainly...
Mark,
Go ahead.
I'm going to take a pause right now, and we have a couple of folks with their hands in the air. So
Okay.
I'm going to unmute them and let them ask a question or make a comment. Our first hand in the air is from Ann. And Ann, you're unmuted. Go ahead. You can speak. Okay, and evidently that was an inadvertent hand. So let's go to Susan. Susan, you're unmuted. Go ahead and speak. Let me wait. I'm having trouble unmuting you, Susan. Susan, this says that you're self-muted, that you've clicked your mute button. So if you want to speak to us, you're going to have to unmute yourself now. And again, I'm going to guess that that's an inadvertent hand. So, Mark, I'm going to try to clear some of the questions out right here.
Okay.
And we don't have any. We just have a comment from Herb from the Northern Traders, and he just wants everybody to know that Chuck Brunell deserves all the credit for the Northern Traders. He was third in the contest, and he was the one that picked most of the stocks for the Northern Trader trading portfolio. Bobby wants to know, are all these clubs BI clubs? And Bobby, I can attest to a large number of them because I know people from a large number of these clubs, but I can't tell you for certain that they're all BI clubs, every one of them. We do know that that's a very difficult piece of data to gather, the names of the clubs that belong to Better Investing. But I can attest to probably many more than half of them, but they definitely are BI clubs.
Yeah, and I can't think of any that are an exception, Ken. So as far as I know, most of them are very closely affiliated with their local Better Investing organization.
Richard has his hand up, and Richard, you're unmuted. Go ahead. This is Richard Miller. Richard, your hand was up and you're unmuted. You have anything to ask?
I didn't know that.
Okay, I'm going to mute you back up again. We had an inadvertent hand being raised there.
Experimentation.
We're hearing you right now, Richard, so you need to be quiet until I mute you again. There we go. You're muted. Okay. So we're clear, Mark, and so you can continue, okay?
All right, and just some other stuff that we might take a look at in answering this overall theme is just a nod to David L. Babson and Brad Perry. By the way, that book was the first book review ever done in Better Investing magazine back in 1960, Investing for a Successful Future. And David L. Babson was known, along with T. Rowe Price, as the originators of growth investing as we know it today. And if you want a little bit more information on that, there's a link at the bottom to a cover story we wrote centered on some of the recollections of Brad Perry, who succeeded Babson at his company. Okay, so let's go ahead and dive into this last topic. There's a couple questions here that we can really boil down to. Things are going to get messy. Now, messy in a good way, but messy. And Valerie asks about seeing disruptions in the EPS reports for the quarterly reports for a number of companies. And Bill Thompson gets even more specific and points out that Johnson & Johnson comes in with, I believe it was a $13.6 billion financial write-down. Southwest Airlines is joining the club along with, I think there was another company listed here also. And we are starting to see more questions about this. And again, as the year unfolds and here over the next several weeks, we're going to start to see analyst expectations reflect some of this stuff. What I thought I would share here tonight is just a quick look at what I'm seeing as I do the weekly updates. We do the batch of companies, about 130 companies every week that come out from Value Line. What we're looking at here is a chart on just the issue 2 companies. That's the ones that are in the current update batch. A lot of restaurants and those type of companies, maritime. I'm trying to think what else is in the group, but basically a whole bunch of restaurants and economically sensitive type companies. Some of the information services companies are in there, like Maximus and some of our favorites. But what you're looking at here is the net margin over time. So those would be actual median net margin percentages from 2004 up through 2016 for those 125 or 130 so companies. So you can see that they basically have floated between 6 and peaking out in 2015. Here was the period of the recession back about 10 years ago. By the way, with the companies in this particular issue of Value Line, you can see why it felt like a recession for some companies here over the last couple of years. The solid green bars are the after, or the very first. It's kind of, we call it ratcheting forward a year, because Value Line rolls their data array to include the next year. So, for example, the 2019 forecasts are in, where a month ago it would have been just the 2018 forecasts, and then you also gain that additional year 3 to 5 years out, which is now the average of that is going to be 2022. And what we are seeing kind of across the board as they begin to digest some of these changes and some of the enhancements in business models that we see, just in 2017, you can see a slight uptick in where they think the year is going to end. But then also the 2018 estimates have been elevated. And what I want you to notice is the 2019 estimates are, now basically unprecedented, at least over the last 20 years or so. And notice that even the 3 to 5 year estimates are in uncharted waters. Is it possible that they're being grossly optimistic about this stuff? Don't know. But what we can say across the board is that analysts not only at Value Line but at S&P and various other places are ratcheting up expectations. And again, these companies are all being given an offset of cash to figure out what to do with. The tax savings from either the adjusted tax rates or the repatriation can basically be deployed in many ways. And that's going to be on a very company by company specific deployment and the decisions that are made, the discretionary decisions that are made. So this is what you're looking at across the board for issue 2. And we're going to be watching this very closely as the next updates unfold. But just want you to be aware that the profitability expectations are taking off. We started talking about this a year ago. You can go back and look at our updates from a year ago and see that we were noticing this type of thing. And I'll go back when we get to the question and answer session here in a few minutes. And one of the major investment research firms came out with might have been Goldman, I don't remember who it was right now, came out and basically said their expectations are bullishly taking off. And this kind of dovetails back with what Ken said a few minutes ago about stocks are certainly not as pricey as they were a few weeks ago, and they still may not account for this type of stuff going forward. Any thoughts on this, Ken?
Well, no, but we have a question, Mark. We're a little bit of confusion with the green and the red. Can you go into that again? Especially, why is the 2020 one bar red rather than green?
Okay, well, just think back a month ago, the 3 to 5 year forecast would have been for the year ending 2021. And now that we're basically ratcheting, again, for the issue 2 batch update, we're ratcheting ahead 1 year. So the most recent actual year is now going to be 2017. And we now will have forecasts for 2018, 2019, and again, that 3 to 5 year forecast will now be 1 year beyond 2021. Shown here is 2022. So,
Mark, would it be fair to say that the bars from 2017 through 2022, if they're red, those are numbers that came from the let me back up, 112, from the November issue of Value Line issue 2. And if they're green, those numbers come from the February issue 2 of Value Line. Is that fair to say?
You got it. Probably why you were a teacher for a living. That's a good way to describe them.
Okay, so for those 3 or 4 people that have asked the question about the colors, from 2016 backwards, that's history, and those bars would have been the same in the last November's issue 2 or in February's issue 2. Mm-hmm. But in November, Mark pulled average numbers out for 2017, 2018, and 2021. So those red bars represent numbers that were pulled out of the November issue 2. And then he pulled new numbers out for 2017, 18, 19, and 2022. And those are coming from the February issue to right now. You have to understand that value line's continually rolling over, and the chart is changing once a fiscal year. So when that chart changes, our 3 to 5 year goes up 1 year, and that happened from the November issue to the February issue. We went from 2021 representing 3 to 5 years in the future to now 2022 representing 3 to 5 years in the future.
Yep, that's right. So again, what you're looking at is the bump up. It's basically a boost. And it's not uncommon to see a little bit this time of the year, but again, keep in mind you're looking at unprecedented levels. So it's just something to keep in mind. And here's a reminder. This is something you might want to think about. Again, back at that expectingalpha.com site, that's our blog. So we just published some highlights there. But in this particular issue, using that link at the bottom of the page, we talked about how you had to look at Church and Dwight, ticker symbol CHD, a little bit differently sometimes than we had with our stock selection guides. And that other chart there from the St. Louis Fed just shows you that those net margins going all the way back to 1940. Kind of a cool chart. So again, the message from us is we don't know what's going to happen. We know that every company is going to be, virtually every company is going to be faced with a pot of money with which to make decisions about where does it best go. Is it best served by giving it to the employees as wages, which is just simply shifting it to another expense category? Does it make more sense? Johnson & Johnson talked about buying down or paying down debt. They're going to make different decisions. Some companies might actually take the opportunity to reduce their selling prices in the hopes of capturing more volume. So again, it's going to be very strategic on a company by company basis. And these numbers really are a mess. This goes to the question submitted by Valerie and then seconded by Bill Thompson. The 2017 as reported numbers for Johnson & Johnson are 47 cents for the year. That includes a one-time non-recurring that drives that number all the way back up to, in their opinion, $7.30. That's a fairly massive difference. And again, all they're doing is a one-time tax accounting to you can actually dig into it a little bit. I don't pretend to be a CPA. I don't play one on TV. But if you are one or you know one, you can actually go to the shareholder investor relations site at Johnson & Johnson and go specifically to the link at the bottom of the page, and they will give you the actual breakdown of what they are accounting for.
Yeah, I think we should make the point, Mark, that the diluted earnings per share, if you can stay on that slide for just a moment, that 47 cents, that's what's going to come through in your Morningstar data from your Better Investing data feed. This $7.30 adjusted will be a number that some analysts use to do the analysis for Johnson & Johnson going forward. So you're going to have a huge range in what number is going to be chosen, and some of the analysts might not choose to adjust all the way up to 730. They might adjust a partial way depending on what the various categories of adjustment represent. So you're going to see 47 cents in the Morningstar data, and you're going to see a variety of adjusted numbers depending on the data source you choose to take a look at.
Yeah, and just to reinforce what Ken had to say there, if you go to the investor relations site, take the subject of trying to determine an effective tax rate. Johnson & Johnson's current effective tax rate is about 20%. They actually estimate that the tax rate after these changes is going to be 15 to 16%, and they itemize that out and spell it out. My go-to for stuff like this is very commonly Value Line. And you can see that their numbers here are not quite the same as Johnson & Johnson's. They have not adjusted the numbers quite as much, but you can see that the 620 number here is certainly not 47 cents. And they do mention it all here in the notes. So again, you've got the opportunity, if you really want to know as an accountant exactly what are they doing, you can go and look at the reconciliation statement. My preference, especially just out of recognition of time on my part, and for beginning investors, and for that matter, almost any investors, this type of information can be very supportive.
I'll tell you also, Mark, that if you're just dipping your toe into the water of these kind of adjustments, you might start by looking at the press release that comes out at the end of the quarter, that comes out before the actual SEC report. The press release many times, not 100% of the time, but almost 100% of the time, does a pretty good job in simple English of outlining the adjustments that they make when they're going to present a GAAP number, which goes to the SEC, and an adjusted number, which goes out to the analyst community. And they explain it in the press release in pretty plain old simple English. You can then find the supporting evidence within the quarterly or annual report. But if you're just looking for why the adjustments were made, I would start by accessing the press release and just reading it. It's probably easier to read than any of the other documents we're discussing.
And I do think it will be fascinating to watch where the money goes. Again, it comes it's kind of the follow the money type thing. You can actually see the $14 billion disappear from the checkbook at Johnson & Johnson. It's going to be fascinating to watch, how that stuff is restored and accounted when they do repatriate and all the other stuff that's going on. So it'll be kind of fascinating to watch. All right. So any other questions or comments at this point, Ken?
No, except that I would urge you to ask a lot of questions of some of the experts in your area, and don't abandon the business model that we use in Better Investing or the preferred procedure that's in the Better Investing tools, but remind yourself that until the data shakes itself out a little bit, you're going to be doing a lot more guessing for the next 2 or 3 or 4 or 5 quarters than you're used to doing. That is all the better reason why you're probably going to want to focus on high quality companies, because when you're focusing on high quality, you have a much better shot of ending up with something that you can support as far as your thesis is concerned, and you can also understand pretty clearly what they're doing in most cases.
I just went back to underscore what Herb had to say about Chuck Brunell. He's been at the top of our results here for years, and Chuck is a fascinating, wonderful guy with good investing ideas. Just an example of really solid club partner to have. And there's all kinds
and
of...
Herb and Chuck are both directors on the Mid-Michigan chapter as well. We're so glad to have their expertise and their quiet, thoughtful way that they deal with stock investing. It's a joy to talk with them about it.
All right. Any other questions, Ken? Anything we can dig into?
We're just getting a question from Kay, and Kay's kind of on a different topic, but she wants to know if anybody, if you specifically, Mark, have any thoughts about Berkshire Hathaway adding Teva to its stock of companies, to its stable of companies.
I have not actually looked at any of the details behind it, but it actually started getting some favorable press. It does seem like the management turbulence at Teva is coming along a little bit better. As Cy pointed out in his presentations at the roundtable a couple of years ago, they actually had a fairly close partnership with Procter & Gamble, so there probably are some very, very good ties on the people side to this whole equation. It'll be interesting to watch. I think that that's an example of a company with a lot of potential that really got locked in some turbulence and some pipeline challenges and that kind of stuff. And it'll be interesting to see if some of that stuff is getting sorted out And again, it comes back to that notion of a very long-term perspective. One of my favorite examples of that recently was our selection of Polaris for the roundtable, and that certainly had a trying year, but by gosh, it's up 60-70% in the last year. It's taking a breather now again, but again, we don't look at quarter to quarter. We very rarely even really look at year to year. And when you start stacking some of these companies out, and Teva is an example of that, Teva, keeping that long-term perspective can really generate some different perspectives on the companies that we study.
Mark, we have a hand in the air from Bobby. Bobby, you're unmuted. Go ahead.
Yes, hi. As you know, I do a newsletter for our chapter, and this one paragraph that you stated that there is little in today's news that has a bearing on wealth, et cetera, et cetera. Did you say that was written by Don Danko?
It was.
Or who was the author of that?
Was
it? Okay.
It was the editorial advisory team at Better Investing back in October 1991. It's actually a featured article at Manifest Investing right now. It's the first article on the homepage where you can get the complete text. That's just the closing paragraph. But yeah, that's definitely Don Danko.
Okay, I just wanted to give proper credit, and I wanted to make sure.
You're welcome.
Thanks.
Thank you.
Mark, I've cleared out the questions. I don't see any written questions and no more hands in the air. And so I'm going to count to 10 because that usually elicits a couple of hands or a couple more questions. But
that means it must be time to watch some hockey.
Yeah, things are staying pretty quiet, so it's probably time to get ourselves to the Olympics if you're an Olympics junkie. And we'd like to thank the folks that offered questions for us to discuss this evening. This seems to be something that people like, and maybe we'll try to do it once every 7 or 8 months. But our next turnout is we're going to skip March, and we're going to move to our next turnout, and it's going to be in April, and it's going to be scheduled on April 3rd. So if you're putting your calendars together, our next turnout Tuesday will be April 3rd. My wife, my gorgeous, wonderful, terrific, talented wife will be sending out the emails and reminding you to register for that. We also have Roundtable coming up the last Tuesday of February. That Roundtable will be the 27th of February. So we hope to see a lot of you at the Roundtable. We promise to have some good stocks for you to consider. And I still have no hands in the air and still have no questions. So, Mark, I guess it's time to say good night.
Well, good night, Ken. Thank you so much for your support.
And thank you for helping out on all these things that you do. And you know that I think that these are great programs for our community. Good night, everybody. Thanks for coming out, and we'll see you in a little bit more than a month. Bye-bye.